10% down. So, but a lot of people also own properties. I think a couple of people will raise their hands, and they might be equity rich. Also, they might not have the down payment to put down, but they might be able to use their property as equity to buy another property. So we call those cross collateralization loans. So we'll take your property, and then we'll take the new property that you're going to buy. We'll use the equity of this property for you not to put any down payment on the new purchase, right? So those are great things that you could do as far as buying a property. You don't have to come down with money out of your own pocket. The other thing that's one of my favorite things to do in the United States is we don't have that many tax benefits, but one of the tax benefits that we have as an investor is if you sell a property and you do a 1031 exchange, you can be exempt from paying property the income taxes, or the capital gains taxes, I should say. So you can roll that over to a new property. So these are things that I personally love, just because we're paying taxes for nothing at this point. So if you could just move that money over and buy something else with that additional cash. So, and, you know, obviously capital gains could be hundreds of thousands of dollars, and $100,000 is going to equate to another, I don't know, $500,000 purchasing power, I would say. So if you're going to put 20% down, that's $500,000 chopped off if you pay taxes. Whereas if you move that money to a new property, you could buy something a little bit more expensive. Now, the reason why I bring it up is because there's ways of doing that. There's also this thing called reverse exchanges as well, where you can buy a property first and then sell your investment property. And that's financing is not available for that generally. We do them because we understand reverse exchanges, because it's just mechanics. It's about like, it's like a tip, right? It's an agreement. You're getting an LLC. So our attorneys will read it and understand it, versus it's intimidating for like some of the larger organizations, or, you know, some of the smaller organizations. So you don't have that support of reviewing this kind of documentation or streamlining the process. So we try to make it where we try to make sense out of financing, make it available for everyone. So I guess the cross collateralization is one that I wanted to talk to you guys about. The other thing I wanted to talk to you guys about is 1 to 10 units. A lot of you guys are probably going to invest into 1 to 10 unit properties. You're not going to buy a 50 unit, 100 unit property as a first time buyer. 1 to 10 unit properties to us is considered small balance residential loans, and so we'll do them in our office as a residential loan. So it's a very weird caveat that we've created. So we'll lend it to you guys as if we're giving you guys a residential loan, a 30-year fix. We won't have to go through the same qualification process as a commercial lending process, because we find that it's like 1 to 10 units are performing just as much as like a residential loan, like a 4-unit property. So we carved out a program for that, and we made it where people could qualify with their like residential type lending, which is so much easier. One. Secondly, it's a 30-year fixed loan, as Will is saying, that you don't get 30-year fixed loans generally with commercial lending. You get 5 to 7-year fixed. With this product, you get 30-year fixed products as well too. So
Marty, this is for if you're living in one of the units, or you're just buying?
Just buying as an investment. Yeah.
And then also a big difference in regular loans and commercial too is the down payment. So is the down payment different for this type of loan?
So if you're buying a single family, you could put 10%, but yes, you could put as little as 20% down on these onto 1 to 10 unit properties as well too. Whereas if you're doing a commercial loan, we're gonna have to look at the debt service on the property and see if it actually services the property. So let's say if you've got a property that's got a payment of $10,000 and you're getting, let's say, $10,000 in rents as well. With the traditional commercial lending, what we're going to do is look at your monthly payments. One, we're also going to see what your utilities are, what your vacancy factors are. We're going to subtract all that off of the income, and it might come down to $6,000 a month is what you're really netting out of that property, and that $6,000 has to service another $6,000 worth of payments, or you have to like put enough money down where your payments are down to $6,000. Our product, the way we look at it, is that we don't care. We don't care about the property operational expenses. We just look at if the property brings in $10,000 and your payments are $10,000, you're good to go. We don't need to look at anything else at that point. So we're only looking at property taxes and the insurance on the property. So it makes it very simple for people to be able to buy a property and also be able to qualify for higher dollars, so you don't have to come up with a lot more money down. Especially in California and Southern California, it's, you know, obviously rents have not maybe sometimes caught up with the prices. I mean, in some areas they have, rents are really, really high, obviously. So as long as the landlord has increased the rent, but then they're gonna have a price tag equivalent to that rental income as well too. So if you're getting a property that's a little bit lower on rent and the price is, good, you could qualify with just the rental income without having to, go through the whole entire process of going and reducing you're reducing your expenses basically. So, do you have any questions? It sounds I may have confused you guys on that. No, does that make sense? It can be oddly complicated. So those are the two main things that I really wanted to go over, but I really wanted to make sure that, I was available. I made myself available to you guys for questions. Do you guys have any questions in regards to financing? No?
I do.
Yes, go for it. I thought
So-
there'd be so much more questions. Maybe not talk about it as much. Maybe make this like a more workshop like that.
Yeah, so the last meetup we had, there was a few people who were talking about they're first time buyers and they're debating if they want to buy a condo or they want to buy a duplex or triplex. Maybe let us know a little bit about what the financing looks like, getting into a triplex as a first time buyer and being an owner user. What are the different programs available, FHA, and what are those limits again? And
Sure.
just
Yeah,
talk a little bit about that. Yeah.
One of my favorite things to do is buy investment property while you're living in it as well. So it's a good way to get into a property, and you can take the advantage of the residential lending guidelines as well. So 1 to 4 unit properties with FHA, they will allow you to buy these properties with 3.5% down payment. So that's even less down payment out of your pocket. But there are some qualification issues. I don't want to like mislead you guys. So anywhere from 3 to 4 unit properties with FHA, the property goes through a self-sufficient testing where if the rental income will pay for the property itself. But if you buy a duplex, it's exempt from that guideline. So I'm a big fan of the duplexes. If you find a duplex, you can put 3.5% down, live in one, get the rental income. It's like buying two homes for a price of 1.5 is what I would say generally. So you're not paying the full price, and I like to shop and bargain. So there you go. So we get 2 for a price of 1.5. I'm good for it. So I say to Anthony's point, 2 to 4 units, financeable through FHA and conventional. Condos, the same thing. You don't have to have, but condos you can put very little down because it's 1 unit property. So I mean, what else can I ask on that one? Does that answer your question?
Yeah. So but can you remind us what the FHA the limits are for if they wanted to buy a duplex with FHA or a triplex? Like, what are those loan limits?
I mean, you could go up to $2 million in financing up to 4 unit properties. I mean, I don't remember exactly. I think it's 2.149 is the loan amount for 4 unit properties. I mean, that's a lot of money when you're putting 3.5% down. As long as the property qualifies for it and that services, that's all we care about. What we like with these properties is if you're buying properties that are vacant, we like them because we could use market rents. So if you find a vacant property, generally vacant properties are looked down upon in commercial lending because we want to make sure the property is stabilized, where there's rental income coming in from it. Oddly enough, HUD thinks the opposite. They're like, well, let's just use the market rents and qualify the property accordingly. So I get excited when I see a FHA loan with vacant properties because I'm like, yes, we can use market rents and qualify the property versus somebody that's paying $500 or $700 under rent control. I have a property in Inglewood and the tenant has been paying, it's a 2-bedroom, $780. I haven't been able to increase the rents. So I was like, this guy's made out for, I don't think he's ever gonna leave. So, but yeah, I mean, that's not the case all the time, but it is pretty prevalent. I mean, a lot of people have low, cheap rents and not going to move, and it's handcuffs them to that rental property, I would say. So it makes it very difficult for them to want to leave. I've seen that a lot in West Hollywood. A lot of West Hollywood tenants, they're like, oh, I'm paying $1,000 a month. Why am I going to leave? I was like, well, you're not making appreciation. You're dumping that money in the trash every month, and so there's no upside to your rental piece of it. But yes, of course, they're going to have to pay a lot more money going forward as far as mortgages that they're going to take on. So.
Awesome. So you mentioned that you had a program where you could purchase a unit up to 10 units with 20% down. Is there any other options purchase a triplex or fourplex with less than 20% down, number one. And then number two, with FHA, is there a number that you're seeing in LA? Because you said a lot of triplexes and fourplexes aren't servicing the loan with the income. Is there an amount that people have to put as a down payment to make it happen? Like, is it maybe just 10% or 15 on average, or what are you seeing? Yeah.
So let me answer that question. So yes, we saw a little gap in the market where 3 to 4 units, FHA was not able to service it because rents were not increasing as fast as values of homes. So Fannie Mae came out last year and they said you could buy 3 to 4 unit properties with 3% down, as long as you're going to live in one of the units. So it's the same exact concept. Rates are a little bit higher on Fannie and Freddie loans, but you can put as little as 3% down on a 3 to 4 unit property as well. Now, to Anthony's point, you can't make up that difference, right? Like a lot of people say, well, can I, if the property doesn't debt service with 3.5% down, you can't make it up with your income. But what you can do is you can pay down the balance to make sure that the debt services itself. But that's a lot of money. You're going to put like if you're going FHA, you might as well just do conventional at that point and not have to have the mortgage insurance and things of that nature that comes along with FHA loans. So if you're going to put 20, 30, 40% down to debt service the property, it doesn't make sense to go FHA. Then you'll go to the conventional route, like through Fannie Mae or Freddie Mac, whatever it may be, or even our own proprietary products. We have our own products that we have as well too that allows you to put 10, 15, 20% down as well. So we recognize values. We've come to the point where we recognize the worst is behind us. We're only going to get valuation is going to be supported. We're not seeing possible values dropping going forward. I mean, unless there's some major thing that's going on with unemployment here shortly, like we did not anticipate a 50 basis point drop today. We anticipated a 25 basis point drop today. So it made everybody a little weary thinking what's coming up ahead of us as far as unemployment goes. But home values are going to be fine just because the fact that there's shortage of inventory. We don't have enough inventory that's coming up. We're not building here. Maybe in areas like Texas or Florida or other areas where there's so much growth happening, there might be some fluctuation in values, but I mean, you're in prime LA, so you're not going to go wrong unless even if you go outside of LA a little bit in suburbs, there's no new construction coming on. So inventory controls values at this point. So.
Do you need reserve for your program?
Well, not on the FHA. On
I'm talking about your proprietary program for 10 units.
6 months.
6
Yeah.
months, okay.
Yeah, it depends on the loan amount. So if you're going up to $3 million in loan, we're going to want to see 12 months of reserves. If you're at like, I think 2 million or under, I think it's 6 months.
6 months.
Yeah.
So yeah, the big news today, right, was the rate cuts. They cut them half a percent instead of 0.25%, which everybody thought. So our understanding is that rates have kind of already come down over the last week or so, and anticipation of the 0.25% rate decrease. Will they come down more now because it was an additional 0.25%, or what do you think?
So I'm not an economist.
Tell us your crystal ball.
I'm an econ major and an MBA in finance, but we'll see. Let me see if I take my best stab at this, right? Yes. So when we're looking ahead, we're looking at three. I mean, you guys probably in the back when we're working at Merrill Lynch, you guys know this as well too. You're always looking ahead, 3 to 6 months ahead, and we're projecting things accordingly. And the bond, the 30-year fixed loans are connected to 10-year bonds. So we look at the 10-year bond, what it's trading at, and the yields of that of the 10-year bonds. We've already priced in a 0.25% drop. Now, like I said, I mean, everybody got a little weary today about the 50 basis point drop. It's like, whoa, like we were not anticipating this. It was a little aggressive. We were talking about it, but I think it was like, I don't know. So what do you guys think? Was it like 75%, 25, and then 25%?
Something like that. I mean, the 50 basis point thing literally came about like the last week.
Yeah. It was very recent. So I think it's more about, to answer Anthony's question, I think we're going to probably look at next month or next meeting that they're going to have to see what numbers are going to come out. And I think that will be a big indicator of where rates are headed. I mean, I think they're going to probably stay similar to what it is today and maybe a tiny bit lower, but nothing significantly lower if we don't see any major supporting values to what they did today next month. is my understanding. So, what was that? Will I have a question?
No, I wanted to say I actually watched the press conference with Chairman Powell today, and what it seemed like based on a question from one of the reporters that was at the press conference, it seems that the reason for the 50 basis point rather than the 25 basis points was because I think if the unemployment report that came out in July had come out just a few days earlier, they might have cut the quarter point last month. So they're trying to play catch up without Fed never likes to admit mistakes, but like basically he intimated like, yeah, if we had seen that report before our last meeting, we might have cut back then. So basically the 50 basis points was to make up for the fact that unemployment's starting to inch up. So they wanted to make sure that they've got enough runway that they're moving forward. And he said, if you look at what the other Fed governors are saying in terms of how many more rate cuts they're expecting, almost everybody expected more, right? Some of them expected 3 more rate cuts. Some of them expected 4 more rate cuts. But generally speaking, almost all the governors expected to have 3 or 4 more rate cuts.
Yeah, it was expected a little while ago. I mean, he should probably run for politics as a good politician. So he's a good speaker. But yes, it's been expected a while ago. And I feel like we've kind of been past this whole inflationary numbers for some time now. But, you know, we just saw it today. It's just, as long as you have more supporting documentation or supporting data that comes out that says, yes, unemployment is not going to be like, you know, falling off the cliff. We want to make sure that that's not going to be the case, because as lenders, we want to make sure that we're giving loans to people that are going to have jobs down the line, and we're not going to end up holding loans that are, you know, not going to be paid. So it's really, really important information. We don't want to like drive the market even further lower where everybody's getting loans, and now we're going to be stuck with loans that we can't, you know, get payments on. You know, we definitely have seen refinance, like even today, the phones are ringing off the hook. It doesn't mean, I think this is probably a good question for you guys get always too, is that everybody thinks that the rates drop by 50 basis points or 50.50%. So if they were getting quotes of 6.5, let's say, now they think their rates are going to be at 6. That's not how it works. It generally affects credit cards, it affects home equity lines of credit, it affects you know, car loans and things of that nature is what the short-term interest rates affect. It doesn't affect the 30-year long-term interest rates. It does have an indication on it, but it doesn't affect it. It doesn't correlate directly with one another. So, but I definitely see volume. Like I'm going to see a lot of people probably moving out of their properties. There will be much more activity in people that want to get out of their homes that were locked into 3.5 or 2.5, whatever interest rates they were at. And I can't believe we were talking about 2.5% interest rates, but it was real. It was a once in a lifetime event. But I feel like that's going to change because people have babies. People they get older. They have their life changes. They gotta move. There's gotta be things that are happening that will get them to the next step, obviously. And now we have personal debt that's gone through the roof. I mean, credit cards are through the roof as far as like debt, personal debt holdings, and also delinquencies are very high on those. So I think people are going to have to sell to get out of these debts and pay off their credit card debts or whatever debt that they got into. So, so there'll be a lot more activity here shortly, I would say. So get ready, know your options, get pre-qualified. Definitely speak with professionals to make sure that you actually have you're in position to strike on if there's a deal that comes on the market that would fit your needs, and or these are not like things that we could talk about in this setting where I'm going to explain every single thing. They're so intricate because it's very specific to your personal needs, and it's also very specific to the property needs as well too. So if the property is a TIC, it's a whole different way of analyzing this versus a commercial property and or a 1 to 4 unit. If you guys tell me that you're going to want to move into the property, the whole analysis is completely different. So it's a fun experience. I think you'll learn a lot, going through it. And it's not as intimidating as everybody makes it sound like. I mean, I think I've been doing this for 30 years. And I think we try to make it as simple as possible when people go through the process. So yeah. Any questions for you guys? No? That's cross.
No.
No?
Information.
do you do any reverse or
So
tender
I
charges?
don't do the, that my mother does the actual escrows, we have a bunch of escrow officers. I've known they have done a few duplexes and a few triplexes. We've been venturing into the commercial section as of now, so I haven't personally dealt with any fires put out, because that's usually when I get called in on fire,
Okay.
or on file. So I haven't had any fires put out on any triplexes.
It's always good to talk to an
duplexes.
escrow because they see so many different transactions going through their hands as well, just like we do. So it's always like nice to volley with you guys sometimes to like, oh, I had this, crazy transaction. And so the best thing to do is to give you guys live examples. I mean, I think the best examples are the 1031 exchange situations where a lot of people are buying and then moving up their tax basis to another property. I love it. When I see that, I'm like, what a smart person. That's such a good job what they're doing. So, do you have any questions, Will?
No,
No?
I think, all I can say is that what I like about Marty and his group is that they're very creative when it comes to financing. So a lot of lenders will find, like, basically, lenders are generally conservative, right? I mean, I've worked with a lot of banks and over the years, and they almost always find a way to say no. Marty always tries to find a way to say yes. Marty always tries to figure out, like, what is the most creative solution. Not all of us are W-2 earners. Not all of us are, a lot of people have various different financial situations. What I like about Marty is that he always, like, whatever situation you're coming from, if you're an international investor, you have 1099 income, whatever it is, he will figure out from where you're based on and help you get that income property. So that's what I appreciate.
Thank you. That's how we started in this business. I started in the business with doing loans for entertainment people with very unstable income. They go from one show to the other and they're acting and whatever. But they've demonstrated being able to pay their mortgages back and or their debts back. And so we take that knowledge and we apply it towards current lending practices as well. So to give you an example, so somebody, let's say, comes over to us and says, Marty, I'm making, I don't know, $200,000 a year with my income of, I don't know, my self-employment income. I'm doing roofing work. I'm a self-employed individual, and we look at their income in many different ways. We'll look at their taxes, we'll look at their bank statements, we'll look at their P&Ls. And if that doesn't work, we'll look at their assets. If the guy's got a lot of assets, we've got a lot of aging people that don't have jobs anymore, but they have a lot of assets in the bank. And in lending, we look at that as like, oh, you can't pay back the mortgage because you don't have monthly income coming in. So we'll look at their assets and we'll amortize that and make that into an income. Or we'll also supplement that. So we'll say, okay, if you got a W-2 income, but yet, you inherited, I don't know, $500,000. It's sitting in a bank account and you are earning interest on that. Why don't we use a portion of $500,000 as an income to qualify? You don't have to do anything with it. It just sits in your bank account. We look at it and go, okay, well, you have $500,000 in the bank. Let's just use that as an income, amortize it over 5 years and use it like an additional $3,000 a month and qualify you. So these are creative things that, as Will was talking about, that the bank and or, I don't want to say the bank, I mean, and other institutions may not look at it the same way as we would. So, and that's the sad part to me. It's like you might be told no, and then you go, oh my God, I was told no, I can't qualify. Or you hear like your cousin who's making $500,000 a year. It's like, oh, if my cousin can't qualify, I can't qualify. There's a lot of misinformation out there. Do your own homework, go through a process yourself, and your situation might be vastly different than somebody else's.
Yes, I think, we've all had those experiences as realtors where a buyer has just been said no to so many times. And we're like, we know it could work. We need to figure it out. We'll find somebody that's going to make it work. And so many times Marty is that person. So
We call it the Bernie laws. They come
yeah, we're like, we have 10 days to close. Thank you, Marty, so much. You're always been big inspiration to me, one of the smartest people I know. I always say that because you really are, and we appreciate your knowledge and bringing that and sharing it with all of us as often as you do. So thank you so much. I appreciate it. And just, give him a hand. Yes. Just wanted to give everybody an opportunity to hang out and meet each other. We have a great group here today, so say hello, meet somebody new. And is there anyone online who has anything they want to say that didn't get a chance yet? Okay. Well, I'm going to turn it over to the room and you guys have some fun and network. If anyone wants coffee, water, anything, let me know and I'll grab it for you in the back and meet somebody new and have a little fun. Thank you, Will, so much. We appreciate you.
Great to see you guys.
See you next week, next month.
Next month. Bye.
Bye.